Aloha, my name is Joanna Amberger, and I founded Three Financial Group to help women and the LGBTQ plus community take control of their finances and live life on their terms. Today, I'll be discussing the emotional cycle that can impact your financial decisions. It can be increasingly difficult to separate your emotions from your finances, especially when your goals are often emotional in their own right. For example, buying your first house after your divorce, sending your child to college, or just retiring on time. Money is never just money for so many of my clients. Money represents financial freedom, hope, and comfort among many other strong emotions, and that's perfectly normal. That's why we always encourage investors to understand the psychology behind their personal finance and investment decisions. According to a psychological study, emotions drive 80% of the decisions we make through our lives. That's a huge part of our decision-making process. Practicality and objectivity, on the other hand, only 20% of our decision-making process. That's because that feeling part of our brain tends to work a lot faster and much more impulsively than our logical side of the brain. Think about it this way. How many times have you justified a decision by saying, it just feels right to me? These types of impulsive decision-making processes can have expensive consequences, though. Now, while it's important to understand your emotions and values when you're developing your plan, your investment strategy will be much more healthy if you try to separate your emotions from your investing decisions. The most common example of this is in the stock market, which has endured its fair share of volatility, with plenty more to come, I'm guessing. Now, when you find your stocks have dropped, when you're looking at those monthly statements, you might find yourself experiencing an emotional roller coaster. It's hard to think about that long-term game when you start to panic. Impulsive decisions made in the heat of the moment can wreak havoc on your investment strategies and ultimately your overall financial big picture. The impulsive buying and selling of stocks based on your emotions is just one part of the emotional cycle of investing. When we invest based on emotions, we're acting directly opposite of the logic of the market. So think about this. When the market's going up, we feel amazing. People think this is so easy. Any fool could do this. I can quit my job. I could trade full time. And then when the market inevitably drops and goes back down, people often panic. But when we look at what's actually happening to the prices in the market, we learn that panic and impulsivity is not the right move. So when the market's going up, prices are also going up. When the market is falling, prices are also going down. Now think about this. You remember that saying, buy low, sell high. But our emotional brain is screaming, buy high, sell low, at the exact wrong time. So we need to understand the psychology behind our decision making, and that makes it so we can take steps to overcome the bias and that emotional cycle of impulsivity. So if you're looking to make smarter financial decisions and take the emotions out of it, get in touch with us. We can help you build a plan best suited for you, your needs, and your goals. Sometimes all it takes is a little bit of guidance.